Currency pairs explained for beginners. Imagine someone tells you they made money because EUR/USD went up. At first, that might sound confusing. How can two currencies be joined together? Why does their price keep changing? And how do traders make money from those movements? These are questions many beginners ask when they first see a Forex chart. The truth is, understanding currency pairs is one of the most important steps in learning Forex trading. Without it, charts, prices, and market movements won't make much sense. But don't worry. In this video, I'll break currency pairs down in the simplest way possible. By the end, you'll know how to read a currency pair, understand what its price means, and follow its movements with confidence. Let's get started. What is a currency pair? A currency pair is simply two currencies that are compared with each other. In the Forex market, currencies are always traded in pairs. You cannot buy or sell one currency by itself. When you buy one currency, you are automatically selling another. Imagine you are traveling from Japan to the United States. Before your trip, you exchange Japanese yen for US dollars. The exchange rate tells you how many dollars you will receive for your yen. A currency pair works the same way. It shows the value of one currency compared to another currency. Base currency and quote currency. Every currency pair has two parts: the base currency and the quote currency. Let's use USD/JPY as an example. The first currency, USD, is called the base currency, while the second currency, JPY, is called the quote currency. A simple way to understand this is to think of the base currency as the item and the quote currency as the price. Imagine you are buying a phone in a store. The phone is the item you want, and the price tag tells you how much you need to pay for it. In the same way, the base currency is the currency being measured, while the quote currency tells you how much it is worth. When you understand the difference between the base currency and the quote currency, reading any currency pair becomes much easier. Whenever you look at any Forex chart, you'll always notice that every currency pair has a number displayed beside it. This number is constantly moving up and down as market conditions change. Let's continue with our USD/JPY example. If the price displayed on the screen is 159.90, it means that 159.90 Japanese yen is the price of $1. The US dollar is the item, and 159.90 yen is the amount needed to buy it. This is the basic idea behind every currency pair. No matter which pair you're looking at, the number simply tells you how much of the quote currency is needed to buy 1 unit of the base currency. Why currency pair prices change. You may also be wondering why currency pair prices keep moving up and down throughout the day. The simple answer is that currencies are constantly gaining or losing value. This happens because traders and investors react to news and events from around the world. For example, if a country's economy is performing well, more people may want to buy its currency. As demand increases, the currency can become stronger. On the other hand, if the economy is struggling, people may start selling that currency, causing its value to fall. Things like interest rates, inflation, employment reports, and major political events can all influence currency prices. As millions of traders make buying and selling decisions every day, currency pairs continue to rise and fall. These price movements are what create opportunities in the Forex market. Types of currency pairs. All currency pairs fall into 3 main categories: major pairs, minor pairs, and exotic pairs. Major pairs are the most common and include the US dollar alongside another widely used currency. Some popular examples are EUR/USD, GBP/USD, and USD/JPY. Minor pairs are made up of major currencies but do not include the US dollar. Examples include EUR/GBP, EUR/JPY, and GBP/JPY. These pairs are also actively traded by many market participants around the world. The third category is exotic pairs. These combine a major currency with the currency of a smaller or developing nation. Examples include USD/TRY and USD/ZAR. Although all three categories can be found on trading platforms, they are not equally popular. Knowing which group a pair belongs to will help you better understand the choices available as you continue learning about Forex trading. Best currency pairs for beginners. If you're new to Forex trading, it's a good idea to start with a few well-known currency pairs rather than trying to follow everything at once. EUR/USD is often the first choice for many new traders because it is one of the most widely followed pairs in the world. Other popular options include GBP/USD and USD/JPY. These pairs are easy to find on trading platforms and are discussed regularly in Forex news and market updates. Starting with familiar pairs allows you to focus on learning how prices move without feeling overwhelmed. It also helps you become comfortable reading charts and following market activity. As your knowledge grows, you can explore other pairs and broaden your understanding of the market. Remember, the goal at this stage is not to know every currency pair, but to build a solid foundation. Common beginners' mistakes. Let's look at some common mistakes that many beginners make when learning about currency pairs. The first is trying to learn and trade every pair they see. With dozens of options available, this can quickly become overwhelming. A better approach is to focus on one or two pairs and become familiar with how they move over time. The second mistake is treating all currency pairs the same. Many beginners don't realize that major, minor, and exotic pairs belong to different categories. Understanding these groups can help you make better sense of the market and avoid unnecessary confusion. The third mistake is memorizing pair names without understanding what they actually mean. It's easy to remember names like EUR/USD or GBP/USD, but what really matters is knowing how to interpret them. Forex is not about memorization, it's about understanding. When you understand what a currency pair represents and how its price works, everything else becomes much easier to learn. Key takeaways. Let's quickly recap what we've covered. A currency pair compares the value of one currency against another. The first currency is called the base currency, while the second is known as the quote currency. The number displayed beside a pair tells you how much of the quote currency is needed to buy 1 unit of the base currency. We also learned that currency pair prices move because currencies are constantly gaining or losing value as traders react to economic news and events. Finally, we looked at the 3 main types of currency pairs and discussed some common mistakes that new traders should avoid. Currency pairs are more than just letters and numbers on a chart. They form the foundation of every Forex trade. Once you can identify a pair, read its price, and recognize what causes it to move, you'll be able to look at charts with much greater confidence. You're no longer just seeing symbols and numbers. You can clearly see what they represent and how they relate to one another. That's a skill every successful trader needs to develop. If you're serious about learning Forex, be sure to like this video, subscribe to the channel, and turn on notifications. Here on Forex Made Easy Hub, we're taking the confusion out of Forex trading one lesson at a time. And trust me, you won't want to miss what's coming next. Thanks for watching.